I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap, and it was a day of carnage in the market. Obviously, huge sell-off today in all the indices. The Dow finished its worst week since 2012. We didn't see this type of sell-off at all in 2013. The S&P closed on its lows. The NASDAQ was even weaker than all of them, finishing down more than 2%. So overall, this sort of has been a long time coming, but sort of hard to envision it when every sell-off so far this year has been responded to with resilience and all the strength that we saw in 2013. But sort of all the faulty signals that we saw at the beginning of this year sort of came to roost in this two-day sell-off. And one of the big reasons for it is an economic reason. It's China, and emerging markets are an absolute mess right now. The China PMI from a couple days ago was the start of it, and just more weak data starts to come in. And it's sort of the type of thing where you're jumping into the pool, and previously we had QE increasing and no indication that it was going to slow down perhaps, and now we have QE tapering starting, the indication that that safety net isn't really going to be there as much going forward in the end of 2014. So perhaps that plays a part in the fact that now this weak economic data is having even more of an impact, and people are a lot more concerned about how much global growth is slowing down. People talked about over the last 2 years the potential for a hard landing in China, and we didn't really get that hard landing. It was sort of a soft landing. It wasn't a pretty picture. China underperformed world markets, but you didn't really see that hard landing that people had anticipated, and that sort of could be the beginning of what we're seeing right now. But going back to stocks, we'll take a look at the chart of the spiders just to get a visual of how nasty this sell-off was today. Yesterday, we had that gap and go to the downside. And without today's candlestick, you look at it and it didn't look like anything that significant. We closed off the lows, people thinking, oh, maybe with the close off the lows, maybe we'll bounce back, maybe get into some of that gap. But you bring that candlestick back in the picture, and that is really ugly 2 days of action. Yesterday, we did still close below the 8 and 21-day moving average on the close, despite closing off the lows of the day. But then today, that big gap down, accelerated to the downside, pierced the 50-day. Now we're sort of in no man's land, and yeah, maybe they gap it up and don't give you a way back in next week, but overall you break the 50-day, you break the previous breakout level, nothing in the way of support until you get down here in the 177.32 spot, which is this pivot low from this candle. But overall, I think when you see a potent down day like this, I talk about this with stocks, and recently it's been talking about this with stocks to the upside, but when you get a potent down day like this, it's an indication that there could be some short-term bounce, there could be some sideways type action, but when you get this type of potency on a sell-off, usually leads to lower prices. And I know the market's been resilient over the last few years and all that, but just because something happened in the past doesn't mean it has to happen the same way in the future. So I think have an open mind right now and be flexible. If you're a long-term trader or an investor, I think you've obviously enjoyed tremendous gains over the last few years, and this is nothing really to be too concerned about yet. But if you're a short-term trader, I think yesterday's action, breaking below the 8 and 21-day moving average, seeing some of the faulty action, I think should have had you in a little bit more flexible tactical mode and perhaps avoided the big carnage that we saw today across the board. And I was looking at stocks, trying to go through and find stocks to show you of examples of the worst sell-offs and things like that, but it's just a similar story across the board. I mean, the broader market, economic weakness, all that type of stuff, when that comes into the frame, it's just a broad sell-off that no one's really spared. There's nowhere to hide, no corners to hide in the market. and that's sort of what we saw today. The only stocks that really held up were ones that held up because of earnings or news or something like that. But I'll just go through and touch on some macro themes before I start going into some individual stocks, but not a whole lot of analysis to do on individual stocks besides a lot of stocks breaking support levels and looking really ugly on their charts. But just take a look at the chart of the Qs. Another index, obviously, like I said, a 2% sell-off, big sell-off to break its 8 and 21 day after holding up better yesterday than the S&P. It doesn't look terribly broken, but you have this uptrend now that's getting threatened. And like I said, based on the potency of today's sell-off, that tells you that at some point I think we'll get another leg lower in the NASDAQ, and we need to work off some of the frothiness that had started to come into the market, especially in tech and speculative names and stuff like that. In 2014, part of you sitting there kicking yourself if you're not involved in all these speculative type names. But when you see a sell-off like this, it's just proof that things I think had gotten a little bit out of hand in terms of money flowing into stocks that really didn't have any business being as high as they were. And then taking a look at the chart of the Dow. Like I said, the worst sell-off in more than a year, a weekly sell-off in the Dow. Took us below 8 and 21 day yesterday and then well below the 50 day today. Its pivot low, it's down here, 15,703. We watched the S&P a little bit more, but good to look at the Dow every once in a while. And then we'll take a look at China. China's been the real sort of I don't know if it's the straw that broke the camel's back, but I think the market right now is looking for a reason to pull in, and this has been a long time coming, and the weakness in the emerging markets, especially in China, has provided an excuse for the markets to sell off and really sell off hard. You zoom out a little bit, it is still in this long-term wedge type pattern, but certainly this week's action closing on its lows, 2 days of really extreme weakness, not what you want to see there if you're looking to play a contrarian type play in China. Take a look at the emerging market ETF, EEM. Similar picture, obviously, with China that week. It makes sense that this ETF would look like this. But emerging markets underperformed big time in 2013. And, you know, on one hand, maybe you look to be a contrarian sometimes, but if something shows that much relative weakness in a year when world markets, for the most part, Europe, Japan, U.S. markets were so strong, that relative weakness tells you that when those markets start to weaken, these could even underperform even worse, and that's what we're seeing so far in 2014. And with money rotating out of stocks as a whole, money was rotating into cash. I think a lot of people right now are just building a cash position, waiting to see how this plays out, see if there's a better opportunity to get back involved for hopefully another bull market run if you're a bull in 2014. Money also has been rotating a lot into bonds. And a lot of people talked about the potential great rotation that still hadn't taken place from bonds into equities, and I think there's a reason for that, and a lot of people still prefer the low risk profile of bonds and the return you can get from those. And take a look at the chart of the TLT. People talked about the end of QE, you know, spelling doom for bonds and stuff like that, but as you can see, really impressive bounce here from the TLT, now back above all moving averages. You take a look at the monthly chart, bouncing off the 200-month support type area. But overall, you did see a nice pull-in in the TLT over the last couple years as the Fed sort of tapped out all of its QE mechanisms and things like that. But the more gradual uptrend in bonds from the early 2000s still intact. So definitely, I think bonds could continue to get a bid especially if we get this type of turmoil in the markets, and today's potent sell-off leads to a little bit more. And then a few sectors. There were some earnings today as well that weighed on various sectors. KSU, I'll just take a look at that real quickly. Kansas City Rail, it's a shipper, a railroad company that mainly ships coal. Huge sell-off today, finished down around 15% despite the fact that it closed well off of its lows. I mean, you look at the damage that did on the monthly chart. I mean, that's a huge engulfing a year and a half of price action for KSU. Doesn't spell very good news for the rest of the sector as well, and a lot sold off in sympathy. You look at the transport ETF, IYT, that is extremely ugly. Now back to its 50-day moving average after being above its 8-day going into today, and that's a really potent engulfing bar. That another one that the potency of that leads you to believe that this is headed even lower. The XLI, the industrials, relative weakness, absolutely crushed today, broke below their 50-day, engulfing multiple weeks, months of price action even. this pivot down here, 49.91 is an area that was key for it. It closed below that. So the next area to watch here could be down 49.13 is this pivot low, which would coincide with the next major moving average, which is the 100-day. I think that's where you could see the XLI, for example, get down to. And the XHB was also weak. I'll just run through some charts because, like I said, the story is very similar in a lot of these names. Some of them held up a little bit better than others, or holding above certain moving averages and higher moving averages than others. But overall, it was just a ton of carnage all over the market today. Banks extremely weak. Citigroup went from being one of the favored names, but after this recent earnings report that was very weak, has become one of the weaker banks. It actually broke below its 200-day, so not what you want to see if you're an owner of Citigroup at all. And if it breaks above this upper level range, you could see definitely a big down move, just challenging the 50-week moving average there. But Citigroup definitely one of the weaker ones among the banks right now. JP Morgan also really ugly day. It's well below its 50-day, almost to its 100-day already, but not below its 200-day like Citigroup. Morgan Stanley was maybe going to be one of the stronger ones after a strong earnings report. It's given back those gains and more today, breaking below some pivots. Goldman Sachs, weak. Nothing really much to say about that, different than the others. Bank of America seems to be the one that's holding up best. Today, it just closed below its 21-day moving average. So if you wanted to buy this dip and accumulate positions, and you want to be involved with the financial, I think Bank of America is clearly the best one to own right now. And just some other names that really got hit hard today. Google had an outage during the day. I think that played a part in the sell-off, but Google hasn't been able to do anything wrong. It's been riding the 8-day moving average up all the way since October, a really nice earnings report back in October. But today, big, potent engulfing bar to the downside, closed below its 8 and 21-day moving average. First time it's been below its 21-day moving average since October. And like I said, that outage, I think, played a part there. When you see a stock like this that's been best in breed and holding up extremely well, sell off like this, it's just a sign that everything's getting beaten down. And then Apple's actually holding up okay. Today actually showed relative strength. I mean, you look at certain stocks in the market today, stocks that sold off 1.5%, technically they showed relative strength because of how hard the indices got hit. And Apple, in the context of the chart, you see a lot of candlesticks and charts leading stocks off of a cliff today. Apple's really just, it was sort of an inside day after yesterday's volatility. So Apple's one that I think is holding up pretty well. And depending on what happens next week, could be one that you look to buy the dip on. Facebook was weak today. That big reversal on Wednesday after that Princeton report came out about it potentially losing 80% of its users, that really prevented a breakout and led to what we've seen the last 2 days in Facebook. But it's one that might need a little bit more time to repair itself after breaking below its 8 and 21 day. Amazon, another one that's been really strong, that got hit hard below its 8 and 21 day. 3D printers. Citron and short sellers continue to target these 3D printers because the valuations are just completely out of whack. Everyone sort of understands that, but it's been sort of a game of musical chairs. Who's going to be the one holding the bag of money at the end? And these have been holding up. They've been hit various times, have responded each time, but now it seems like things are a little bit different for the 3D printers in my eyes. They'll still continue to provide great short-term momentum opportunities, but from a swing trading perspective, I think people are going to be a little bit scared off by the size of the pull-ins that we've seen in these names. DDD was the target from Citron today. Did close off its lows a little bit, but that's really harsh selling over the last couple weeks, and not something that inspires a whole lot of confidence if you're looking to buy and hold a stock. ONVO was a previous target from Citron, also sold off today. VJET, another one, I think it was a bearish report came out that led to this big sell-off, and it also had a big percentage down move today. And XONE, big percentage down move today as well, breaking below its 200-day moving average. The one that actually held up best is SSYS, but who knows what could happen here. I think the sector overall is just broken, and the magic story of the 3D printers is sort of the bubbles bursting a little bit. Just a few more names. The automakers really got slammed today. When you have China weak like this, the automakers are one sector in particular that are relying on Asia and China specifically for their growth story. And you see really weak manufacturing, weak economic data from China. These are ones that are going to sell off. Ford, big down move, now below its 200-day moving average. GM, not below its 200-day yet, but really potent down move today, accelerating the recent downtrend to the downside. Bristol Myers Squibb, not an automaker obviously, but huge down move down to its 100-day moving average. Multi-level marketing stocks, HLF, potential inquiry into its business practices. I think Bill Ackman finally feeling a little bit better this week, is going to have a better weekend than most people that are involved in the market, because he's been pounding the table that this is a legal pyramid scheme and all that. And a congressman actually introduced some testimony this week that could lead people to look into this a little bit more. Hard to really know what to make of these, because on one hand the financials of a stock like Herbalife are really strong, but the threat of potential illegal activity could decimate the stock. So I think it's one that you just don't be involved with at this point. And then NUS is another one, another multi-level marketing one, that after the big down move on reports in China that China is going to rule it's an illegal pyramid scheme, it formed a tight wedge and then broke below it today. The credit cards got hit hard. These are one of the strongest areas in the market for the past few years, but look at MasterCard, huge sell-off below its 8 and 21-day and closed below the 50-day, closing on lows. And what you saw a lot of today, and you saw with MasterCard and Visa, is some days, especially over the last year and a half, when we do have these big down days, a lot of stocks are able to close off their lows a little bit. But today you're seeing so many stocks, so many indices, they were extremely weak and they closed on their lows, which didn't really inspire much confidence to buy the dip. Maybe it's one of those situations where they want to keep things as weak as possible and then gap us up Monday and not really give anybody a way in. I think if you do get a bounce, it's not going to be easy next week. I think they're either going to gap us down and we're going to continue lower and the carnage is going to continue, or they're going to gap us up and not give you a way in. So the market never makes it easy, and that's sort of the scenario I envision for next week. That's why I think just sitting on your hands and being patient right now is the most prudent thing to do. But I think the best exercise you can do is not go through all these charts, even though I just did it, and not go through all these charts and whine and pity all these stocks that got hit really hard, because 90% of the stocks, that's a made-up percentage, but a large percentage of stocks today got hit extremely hard. It was a very broad sell-off. But what you want to do on a day like this is try to find that select number of stocks that held up okay. And I was looking at different heat maps and things like that, trying to identify areas of the market that did hold up well. There weren't very many, but there were some specks of green in there. A few of them at the beginning of the show, like I said, were because of earnings, because of news. But there were some other ones that I think held up reasonably well and should be on the tip of your tongue to start next week. And the ones that held up over news, I'll just touch on those really quickly. Microsoft, it did finish much lower than it was overnight last night, and even during today's session filled about half of the gap from last night. But the fact that it was able to hold higher was constructive. You could either say it's good luck or bad luck that it reported earnings on a day where stocks got beaten down as much as they did today. It did save it from finishing negative and maybe having a composure change, but it also perhaps could have been a lot higher if it wasn't weighed down by broader market weakness during today's session. And Procter & Gamble also reported earnings. This is one of my favorite dividend. It's a consumer staple stock. A lot of really powerful brands in their portfolio, and it's another one that probably could have been a lot higher today if it wasn't for the broader market weakness, but still did finish positive. It's below its 200-day moving average, but if you're looking for a little bit of a flight to safety, some lower beta stocks to put in your portfolio and put away and not have to worry so much about them, Procter & Gamble's a name I really like. And then Starbucks had been one that we had listed on off the charts as a short setup, but we don't take those short ideas into earnings, so we closed it out last night. And then today it had a decent earnings report, and whereas something like Microsoft went into some of its gap from last night's earnings, Starbucks actually held up pretty well, back above its 8-day now, and you can say that it found support at its 200-day prior to the earnings report and is now bouncing. So it could be a little bit of a positive composure shift for Starbucks. And the names, in all the videos I've done the past couple weeks, I've talked about the strength in biotech and about how if you're a swing trader or especially a short-term momentum trader, biotech should be the area that you're focusing on right now, because you're seeing just huge moves. Obviously, some of them have been huge gap ups and things like that, but there's been other setups that have been more methodical, more calculated, and those are the ones I think you should focus on. It was another day. There were some more huge gap ups in the biotech space. BDSI was one that saw a big gap up after a pain. I didn't plug it in right. BDSI. After some pain medication that it has had some positive research on it, and it led to some more attention coming to the sector today. One that I talked about in the morning call this morning, if you watched, was ARIA. It's one that there's been reports that Eli Lilly could be interested in purchasing the stock for as much as $20 a share. Obviously, it had that big down move, and when you see that big of a gap down, the likelihood of something actually going through, who knows, but when you get positive attention, some positive news stories on that, it can lead to a squeeze or a big move higher, and that's what you saw this morning. I talked about it before it had even broken above this pivot. I'm not sure what it ended the day, but at one point it was up about 30%, almost to the $10 level. So not one that I would necessarily be looking to put in the drawer. It has to do more research on the stock and the company, but one that was definitely setting up for a move, and we got a really huge move today if you had a narrow focus on that. PRAN, another one that's been talked about in the VTF that's holding up well. Take a look at the chart. It's been strong, well above the 8 and 21-day moving averages, sort of just ignored the broader market sell-off. And if there's one sector that I think is capable of shrugging off broader market weakness, it's the biotechs. They're less beholden to economic growth and things like that. It has more to do with FDA approvals and research quality and innovation. So broad market weakness doesn't exactly have too much an effect on these names, and that's what you saw in PRAN today. And then two that held up well, bigger names in the group. BIIB, yes, it did have a potent move down, and it engulfed yesterday, but it did hold above its 8-day moving average. I don't think you rush to buy this first thing Monday morning, but you see if this can, on a retest of this prior breakout level, hold, form a little bit of a sideways consolidation, find its footing a little bit, and then perhaps break higher again. I think every once in a while you can't always chase highs. You have to look to buy strong stocks on a little bit of weakness. You don't average down and do things like that that can lead you to really hurt yourself, but sometimes you got to look to buy strong stocks on a little bit of weakness to get better prices. And one that I think that is particularly true for is Gilead. GILD is one we talked about, listed on off the charts. Really impressive 4-day breakout. Showed signs of exhaustion Wednesday, which I talked about. Didn't fill its whole gap, but filled most of it, and then today filled the rest of it and came back down near the 8-day moving average, but still above the 8-day. Just like I talked about with BIIB, maybe look to buy a little bit of weakness on a stock that looks like in the long term, looks like it's headed higher. Some other names that held up relatively well on Wednesday. Talked about Lululemon, put in a red dog reversal. Wednesday's red dog reversal didn't really lead to anything except for a day trade, but today it held up well. And overall, you had that red dog reversal Wednesday. You had today's relative strength. There are some signs here that LULU is looking to find its footing a little bit. It is below all the moving averages. Macro, it's a tough stock, but I think the story is still intact. I know people who still love Lululemon despite all the controversial comments from the CEO. I think people are still buying it. I think there's still room for growth, even though the growth story is slowing a little bit. And you just get perspective on how much this has come down. It's back to levels that it's only seen since 2011. And you look at that chart, macro, it's a strong chart. Obviously, if it gets down into this low 40s area, that's going to be a huge level for it to hold. But right now, like I said, I think it's trying to find its footing a little bit, highly oversold. I think if the market is able to find some footing and reverse back to the upside next week, I think Lululemon could be one that repairs some of its damage. So one to keep an eye on there, but one that I would always have a tight leash on a laggard name like this with stops. Twitter is one that, yeah, it did finish down over 1% today, but like I said, when the market is down around 2%, stocks like this that are only down 1.5%, they actually showed relative strength. And Twitter today looked like it wanted to go early, but was way down a little bit by the broader market. But like BIIB, GILD, other names I talked about, still above its 8-day moving average because of that really impressive run you saw in December. And it's sort of just been digesting that move from December. And the pattern that we have highlighted here is a little bit of a wedge pattern. And today, it's sort of coming to the apex of that pattern. Like I said, volatility calming down a little bit after those huge moves we saw in December, and then the really volatile, choppy action at the start of this year when you had that series of downgrades and then some upgrades. Sort of just digesting all of that. And I think you just be patient, don't lose sight of this. And I think it's one that, could it break lower out of the wedge? Sure, but you just use each boundary of the wedge pattern to gauge your entry there. But I tend to have a long bias here because of the inbound move from December. So I think that's one to keep an eye on. Even Tesla finished down, percentage-wise, showed relative weakness to the market today, but it's an extremely high beta name, so you have to understand that dynamic. But it's also above its 8-day moving average, and another one of those strong names that you potentially look to buy on a little bit of weakness. If it can hold this 8-day moving average, I think it could get back going to the upside for another squeeze, and it looks like it could be headed back towards the highs. So the Tesla, just another name I think to keep an eye on. Did show some weakness today, but in the context of its recent movement, actually holding up pretty well. And then finally, Netflix, I think is one to keep an eye on. I know psychologically, and I talk about this sometimes, psychologically it's hard to chase a stock after it's gone up 17% on earnings, but it held up well today after the gap down, and looks like it could be starting to form a sideways channel at new highs here after the big gap up. And we've seen this multiple times in Netflix over the past few years where you get a big earnings move and then it just consolidates for the next quarter even sometimes, like you saw here. Maybe I can zoom in a little bit for you so you can get a better picture of it. You saw here, just consolidated. Yeah, it was a gap up that sent it higher there, but sometimes you get these nice sideways consolidations in Netflix after big earnings moves. You see one here. Anyways, Netflix holding up well. That's the gist of that. But like I said, a lot of carnage today leads me to believe that at some point we're going to get another leg lower. Will it happen on Monday? Will there be panic that ensues over the weekend? And and Sunday, will we get weakness in Asian markets and European markets? And will that lead to more downside in U.S. markets? Who knows? Nobody knows. I think when you come into a Friday like this and you're a short-term trader, it's just too risky on a day of extreme weakness like this to take too many longs overnight. But could they gap us up on Monday morning and go without letting anybody in? Sure. But right now, it's okay to be in cash. You don't have to be involved in every trade. You don't have to put yourself out there if you don't have any conviction and idea. And just do what I did here. Try to go through your list of stocks. Try to make a list of stocks that held up best, stocks you've been wanting to own, but they've just been too expensive for your taste, and make a shopping list so that if we do get that 10% correction, the big one that everyone's been talking about, that you have a shopping list and you can, with a level head and low emotions, you can go in and you can buy those stocks and then you can let them run for you. And that's the name of the game in my eyes. Sometimes it's good to be tactical and short term, but other times you use weakness to get into stocks that you want to own for the long term. That's more of my perspective, and maybe if we do get that 10% correction, we'll get another one of the best opportunities to buy that we've seen, to buy in a calculated way we've seen over the past year. But this has been John Darsie here for your daily recap. Everyone enjoy the weekend. Don't let the market rule you and affect your life outside of the office or wherever you trade. Enjoy the weekend.